So does investing frequently actually increase your taxes? Does investing frequently means you need to work harder to pay for the additional tax that you incur? And how much harder do you need to work when it comes to investing and paying taxes? And that's what this video is about. So before we start, 96.4% of you guys are actually not subscribed yet. It is free and you can always change your mind in the future. And if you stay till the end of the video, then you'll also know about the giveaway. Now, this is really part of a larger investment tax series where I cover how to calculate capital gain tax, how much tax do you need to pay as a dividend investor and a capital gain investor, and also how much tax do you need to pay if you are investing frequently. So in terms of success stories, I just want to celebrate another success story within Investing Accelerator where Daniel made 150% from FedEx in 7.5 months. So congratulations, Daniel. You're doing an amazing job. And this is the 94th case study in Investing Accelerator. So this month, I'm looking to help 20 professionals without a financial background to master investing and target 30% a year. And the stretch goal is 30 people. So you'll get more details about this at the end of the video as well. So to think about trading frequency and investment taxes, I actually prepared a 10-year Excel worksheet to analyze this problem. And before we dive in, I just want to reiterate that the long-term capital gain tax is what we're going to focus on. And you only pay this when you exit. So the rule of thumb for Canada is 25% long-term capital gain, while for US is somewhere between 15 to 25% depending on the states you're living in. So let's get started. So the first scenario I'm going to cover is that if you invest $100,000 into one stock and you hold it for 10 years. So you don't incur any tax in between the first 9 years and you only take profits at the end of 10 years. So this is probably the lowest trading frequency you can get. You get taxed once. The scenario number 2 is that you invest into one stock each year and you take profit every single year. So then you take profit 10 times. So in that scenario, you actually get taxed 10 times. So the question we're trying to answer here is, if you are taking profit more frequently, do you need to work harder? And exactly how much harder do you need to work and whether that is worth it? So here you'll see the Excel sheet that I have prepared. And for the first scenario, you'll see that you invest $100,000 into one stock and hold for 10 years and you get 10% each year and you get taxed at the end of 10 years. So the tax is 25% and the return is 10% and you start with 100K. So these are the initial inputs. And as you can see, as you are making gain and compounding over the next 10 years, you actually don't get taxed at all until the very last year. And the way this is calculated is actually you sum up all of the gains, because that's how the Canadian or the US government does it, and then you times it by the tax rate. So then you pay tax of $39,844 at the 10th year. Your total portfolio value is $219,531. So you can see that over time, making 10% return, this is approximately 2 point something x. So this is actually 2.2x of your return. So that is fantastic, and you pay $39,000 in taxes. Now, what if scenario 2, you invest into one stock each year, you take profit year after year, every year, and you still get 10% gain. So in that case, you'll see that the formula here changed, where you get taxed every year. So the first year is $2,500, the second year is $2,688, and you keep going until the 10th year. Your portfolio is actually reduced slightly every year. So this actually slows your growth down a little bit. And right now, if you just go to the end and look at the difference, your portfolio value at the end of 10 years for scenario 2 is $206,103. So that means by investing and taking profit every single year, you need to pay $13,000 more in taxes. So this is really the true cost of investing more frequently, looking at just taxes alone. We haven't considered transaction costs or anything like that. So when you try to calculate your change in portfolio, this is 7% of your portfolio. So I just showed you the formula there. When you think about that, across 10 years, you only need to pay $13,000 more in taxes. That's approximately $1,000 more per year. So that means if you want to be more active, if you want to manage your own portfolio, then you need to perform better than if you're leaving it alone by $1,000 a year. So that is 1%. And when you think about it, it is not really a stretch goal. So if I change this return to 11%, then you'll see that this basically reduces the difference significantly to almost zero. It's negative 1% now. So that means if you are able to achieve 11% instead of 10% per year by actively managing it, even exiting once a year. Now, here is another interesting scenario. What if you are making 30% a year? How would that impact this calculation? So I'm going to change the two return figures here. So then it's 30% is up top. And in this case, you'll see that it is almost 10 times after tax, which is what my plan is. And the amount of tax you pay is actually $319,000, $646. So when you think about that, okay, that is a hefty sum to pay near the end. So what would happen if I change this 10% to 30% for scenario 2 as well? So I'm going to change that. And here you'll see that the portfolio will grow from $100,000 to $760,000. So when you think about the difference, it's actually 300K. So when you compare the two portfolios, one is at $1 million and the other one is 760K. So that means by investing frequently, you actually need to work harder and pay $297,000 more in taxes. And when you think about this balance relative to your portfolio, that is 39%. So that is actually quite significant. So that means if you are going to make more moves or investing more frequently in the market, then you'd be better prepared to pay more taxes over time, because it does slow down your return, because this 25% is pretty hefty. When it comes to investing, my goal is really to make 30% a year. And when I first started, this seems like a stretch goal to me. It's like going to Mars. That's why I prepared a 4-hour free training for you to explain how I did it, the thought process that I've gone into it, and also walk you through a couple of example analysis as well. So this is perfect for you if you are a full-time professional with no financial background and you want to learn how to manage your own portfolio and you want to get a higher return than 10%, which is what you get from mutual funds and index funds. So you can go to the first link below, which is 5minuteinvesting.com/free case study to attend the free training. And make sure you grab a cup of coffee or even 2 cups of coffee before you start. Throughout that investing journey, I started coaching other people as well. And that's where Daniel made 150% from FedEx in 7.5 months. So he's the 94th case study. So congratulations, Daniel. And this month, I'm looking to help 20 professionals without a financial background to master investing and target 30% a year. So the stretch goal is 30 people. So if you're interested, go attend the 4-hour webinar, and then we can have a chat, which you'll find a link below as well. In terms of the giveaway, I'm going to be giving away another copy of Sam Walton's Made in America, which is his own biography, and it's a really good read. So if you haven't read this book and you want to learn more about business, what makes Sam successful, what makes Walmart successful, then this is the right book for you. I have read through this book multiple times, so it's definitely one of my favorites. Now, in terms of a previous giveaway where I gave out Harmonic Trading, it's a technical analysis book. Duncan is the winner. So I've sent you the details on how to contact me and how to redeem this book. So if you're watching this video, make sure you go back and send me your details. So in the next video, I'll talk about why delaying investing is costing you $300,000 and what you can do about it. So that's a very interesting topic because most people misunderstood the true cost of procrastination. Most people misunderstood the true cost of delaying investing. So I'll see you in the next video.